If you want to know when the middle class gets squeezed hardest, do not start with wages. Do not start with the stock market. Start with oil. Most people think oil is just what they pump into a car. That is the kindergarten version of the story. The adult version is harsher. Oil is a tax collector that shows up in your driveway, in your grocery cart, in your airline ticket, in your utility bill, in the freight cost buried inside everything you buy, and eventually in the layoff notice that lands on somebody's desk. I have lived long enough to see investors make the same mistake again and again. They treat an oil shock like a headline. I treat it like a system event. Headlines fade. System events travel. They move through household budgets, company margins, hiring plans, confidence, credit, and finally asset prices. By the time the crowd notices the full damage, the pressure has already spread from fuel pumps into living rooms and balance sheets. That is why I always tell people that the last danger in a cycle is rarely the first number you see. The first number is the oil price. The real danger is the hidden tax that follows it into every layer of economic life. That hidden tax is what wipes out the middle class. It does not do it in one dramatic blow. It does it by shrinking room, less room to save, less room to invest, less room to switch jobs, less room to absorb an emergency, less room to say no. The middle class is not destroyed only by low income. It is destroyed when the cost of ordinary life rises faster than its ability to adapt. That is what makes this period dangerous. The conflict in the Middle East may or may not last. Oil may cool off tomorrow, or it may stay elevated far longer than politicians and television experts want to admit. I do not pretend to know the exact path. I have never built my life on pretending to know the next month. I build around understanding the machine. And the machine is clear enough. When oil surges, life becomes more expensive before wages can react. When life becomes more expensive, families buy less. When families buy less, businesses feel it. When businesses feel it, they protect margins. When margins are threatened at the same moment that artificial intelligence is giving companies permission to run leaner, the worker stands in the middle of two blades at once. That is the part most people still do not understand. They think the danger is either oil or AI. No, the danger is the combination. One attacks the household from the outside, the other attacks the job market from the inside. One drains spending power, the other weakens bargaining power together. They can squeeze the same family from both directions. If you understand that, you understand why I am not interested in arguing about whether a recession has officially started yet. The official declaration is usually a late guess to an early fire. GDP reports come with a delay. Committee labels come with a delay. Economic vocabulary comes with a delay. Pain does not wait for a label. I would rather understand the sequence. The first mechanism is what I call the energy tax spiral. An oil shock is not just a commodity story. It is a cost transmission system. Fuel rises, shipping rises, warehousing rises, airline costs rise, fertilizer becomes more expensive, delivery becomes more expensive, food becomes more expensive, commuting becomes more expensive. Vacation plans get cut, small luxuries get cut, some large purchases get postponed. Every household budget begins to tighten, not always with panic, but with quiet subtraction. That quiet subtraction matters more than any dramatic speech. I remember how investors used to talk in certain cycles as if consumers were mathematical creatures. They are not people. Do not cut spending by reading a policy memo. They cut spending when their gasoline bill climbs, their groceries cost more, and their savings account suddenly feels smaller than it looked 3 months earlier. That is how the energy tax spiral works. It changes behavior before it changes theory. The history on this point is not subtle. Over the last half-century, the big oil shocks have repeatedly rhymed with recessionary pain. Not every case plays out the same way, and history never copies itself neatly, but the pattern is strong enough that only a fool dismisses it. When the price of energy becomes a tax on the entire productive system, you are no longer dealing with an isolated market move. You are dealing with pressure on the bloodstream of the economy. The second mechanism is what I call the margin squeeze. Households experience the oil shock as higher bills. Businesses experience it as thinner margins. Their inputs rise. Their transportation costs rise. Their customers become more cautious. Their forecasting becomes less reliable. And in modern business, uncertainty is often punished almost as severely as actual losses. A good business can endure a lot. A weak business breaks faster. But even strong businesses do not sit around waiting to become victims. They respond. They freeze hiring. They cut projects. They trim expansion plans. They stop taking chances on people who need training. They ask managers to do more with fewer workers. Then they start looking at the labor force and asking a brutal question: which roles are essential and which roles can be automated, consolidated, delayed, or removed? That brings me to the third mechanism, and this one is especially important in this cycle. I call it the labor replacement loop. For years, businesses tolerated a great deal of inefficiency simply because replacing human labor at scale was difficult, slow, or expensive. Artificial intelligence changed that calculation. It did not eliminate the need for people, but it changed the threshold at which companies feel justified in reducing headcount. It made management far more willing to ask whether 10 people are really needed, where 6, 3, or even one very capable operator using AI tools might do. That is not science fiction. It is already moving through offices. When oil goes up at the same time, companies are being handed a new toolkit for productivity. Management finds religion very quickly. The sermon is efficiency. The altar is payroll. The sacrifice is the middle tier of labor that once looked safe because it was familiar. If I were 25 years old today, I would not ask whether AI is good or bad. That is a useless question. I would ask whether my work is positioned above it, beside it, or directly in front of it. If my job is repetitive, low judgment, low responsibility, and easy to measure, I would assume the machine is walking toward me already. Oil does not create that vulnerability, but it accelerates management's willingness to act on it. That is why the combination matters so much. High oil prices weaken demand. Weak demand pressures margins. Margin pressure makes automation look more attractive. More automation pressures labor. Pressured labor weakens confidence and spending even further. Once that loop starts, each turn reinforces the next. The fourth mechanism is what I call the confidence freeze. Most people think consumer spending is driven by current income. Only partly. Spending is also driven by confidence in future income. If a family believes the paychecks are safe, they will make large commitments. They will buy the car. They will upgrade the house. They will book the trip. They will finance the furniture. If they worry that the next 6 months are unstable, they pull back even before disaster arrives. I have always found confidence to be one of the most underestimated forces in economics. It does not sit on the balance sheet in an obvious way, but it changes what people do with every dollar. A man who feels secure spends differently from a man with the same bank balance who senses instability coming. When oil surges, headlines darken, layoffs spread, and the public hears that even large companies are reconsidering staffing because of AI, confidence freezes. That freeze has consequences far beyond mood. It postpones demand, and postponed demand becomes weaker revenue for businesses, which feeds right back into the margin squeeze. This is why the middle class feels whipsawed in these periods. Prices move first, confidence falls second, spending retreats third, employment weakens fourth, asset prices adjust fifth. By then, many families have already been hit in 4 different places. The fifth mechanism is what I call the lag illusion. Every cycle has it. People wait for the official verdict. They wait for economists, central bankers, or some formal recession call to bless reality. Meanwhile, reality has already been billing them. GDP is useful. It is not timely enough to protect you emotionally or financially. If you treat it like a steering wheel, the economy may be slowing before the report says so. Jobs may be weakening before the payroll data captures the full picture. Households may be retrenching before the commentators admit that consumer behavior has shifted. The stock market adds another layer of confusion because it does not move as a polite mirror of the economy. It anticipates, misprices, overreacts, shrugs off obvious pain, and occasionally panics over things that never fully arrive. Good news can coincide with falling prices. Bad news can coincide with rising prices. Anyone who expects neat moral behavior from markets is too fragile for investing. That is why I have never built my life around forecasting headlines. I build around incentives, resilience, and arithmetic. The arithmetic in an oil shock is simple enough for any honest person to see. If the household has to spend more to stand still, less capital is left for progress. If the business has to pay more to move the same product, less margin is left for experimentation. If the worker is more expensive and AI is more useful, the bargaining position of average labor declines. If confidence falls, spending weakens. If spending weakens, businesses defend themselves. If businesses defend themselves, jobs are pressured. And when jobs are pressured, the middle class loses its cushion. That cushion is everything. A rich man can survive bad timing. A poor man was already in distress. The middle class is damaged by compression. It is damaged when the monthly machine leaves too little after the essentials. That is why I say oil shocks wipe out the middle class more effectively than they destroy the very rich. The wealthy own productive assets. The middle class often owns obligations supported by wages. One group collects from the system. The other group is required to keep up with it. That is the identity divide most people miss. In prosperous years, many workers think they are one promotion away from safety. In difficult years, they discover the truth. Security does not come from being paid well. This quarter, security comes from owning assets that remain valuable when the cost of life rises and the job market gets meaner. That is the identity flip I want you to make. Stop thinking of yourself as a consumer trying to survive prices. Start thinking of yourself as an owner building insulation. A consumer asks, how do I endure the next spike? An owner asks, which assets gain strength when the system gets tighter? A consumer sees volatility as pain. An owner sees volatility as a transfer window. A consumer waits for reassurance. An owner prepares before reassurance arrives. This shift in identity matters more than any ticker symbol I could mention. The greatest financial advantage is not information. It is posture. If you see yourself as a wage-dependent participant in the economy, you will respond to shocks with fear, delay, and exhaustion. If you see yourself as a future owner of productive cash-generating assets, you begin using shocks differently. You stop asking how to predict every turn. You ask how to make sure turbulence favors your long-term position. Now let me be clear. I am not telling you to celebrate hardship. I never confuse pain with virtue. Recessions hurt people. Layoffs hurt families. Inflation hurts households. But markets have always contained a cruel side effect. Distress often marks down good assets with bad ones, and that is when prepared capital can buy future earning power on better terms. That is why crashes create millionaires more reliably than comfort does. Comfort makes people lazy, and fully priced markets leave little margin for error. Stress makes the crowd dump quality along with junk. The prepared investor does not enjoy the pain. He takes advantage of the mispricing it creates. If I were guiding an ordinary family through a period like this, I would organize the response around a simple operating system. First, I would treat an oil shock as a household stress test, not a temporary annoyance. I would ask one hard question. If fuel, food, and transport stay expensive for 12 months, what breaks first in our budget? The answer to that question tells you where your fragility lives. Until you know that, you are guessing. Second, I would build what I call the friction reserve. Most people think cash is boring. That is because they confuse return with utility. In unstable periods, cash is optionality. It buys time. It keeps you from selling good assets at bad prices. It keeps a layoff from becoming a financial emergency. It gives you the ability to act when other people are forced to retreat. I do not want a family relying on hope while every basic cost is climbing. Third, I would audit labor exposure. I would not ask whether my employer says I am valuable. I would ask whether my role can be simplified, standardized, or absorbed by software plus a leaner team. That is an uncomfortable exercise, but adults should prefer discomfort in private over surprise in public. If the role is exposed, the response is not panic. The response is skill repositioning. Learn the tools, move toward judgment-intensive work, move toward revenue responsibility, move toward trust-based roles, move toward decisions, not just tasks. Fourth, I would separate defensive assets from compounding assets. Gold, for example, can serve a purpose for some people, but I do not treat it as a magical engine. I treat it as insurance. Insurance is useful. It is not the same thing as productive ownership. Productive ownership means businesses, funds, assets, or properties that generate cash flows and can grow with time. The middle class gets trapped when it confuses preservation with compounding. You need both, but you should know which is which. Fifth, I would automate accumulation. I have always liked systems more than motivation. Motivation is expensive and unreliable. Systems are cheaper. If you believe the American economy will be larger 10 or 20 years from now, then broad productive ownership acquired steadily over time remains one of the simplest paths to wealth. I do not need daily excitement. I need an enduring mechanism that turns earnings into future claims on business output. This is why I prefer regular buying over theatrical decision-making. The crowd wants heroics. Wealth usually prefers discipline. When markets fall because the public is frightened by recession talk, energy costs, or labor fears, your instinct will tell you to wait. Waiting feels intelligent because it feels safe. But if the assets you own are broad, durable, and acquired with a long horizon, the markdown often helps you more than the comforting headline would. Sixth, I would know the difference between sectors that consume the shock and sectors that pass through the shock. Consumer staples often retain a role because people still need basics. Certain dividend growers can continue paying while weaker businesses scramble. Energy can benefit if prices remain higher for longer, though that is not the same as saying every energy asset is wise at every valuation. Parts of the technology chain tied to long-term computing demand can still matter, but in a panic, they may swing harder than the public expects. The point is not to chase whatever sounds fashionable. The point is to understand which businesses are beneficiaries, which are victims, and which are merely expensive stories waiting for disappointment. Seventh, I would remember that home ownership and productive real estate are not the same thing. A personal residence can be emotionally valuable. That does not automatically make it an investment masterpiece. In inflationary periods and uncertain labor markets, leverage becomes dangerous when it depends on uninterrupted optimism. The middle class often gets seduced by the idea that rising asset prices can cover weak savings habits. That is a pleasant fiction until conditions tighten. Eighth, I would create what I call the refusal engine. This is one of the most important ideas in personal finance and one of the least discussed. The purpose of savings, investing, and intelligent ownership is not just to grow net worth. It is to increase the number of bad options you can refuse. You can refuse a foolish loan. You can refuse a toxic boss. You can refuse to panic sell. You can refuse to use credit to pretend you are still comfortable when the system is pressing against you. Every dollar of real flexibility increases refusal power. And refusal power is often the dividing line between the family that gets pushed around by a bad cycle and the family that uses the cycle to improve its long-term position. This is why I do not think retirement should be the center of the conversation. The word itself is too passive. What people actually want is financial freedom. They want the ability to live without having every important decision dictated by wages, or short-term emergencies. There are only two honest roads there. Either you own assets you can sell to fund your life, or you own assets that send you cash without requiring you to sell them. Everything else is just a nicer version of dependency. In an oil shock, dependency becomes visible. The worker dependent on a paycheck feels it. The family dependent on cheap debt feels it. The household dependent on constant confidence feels it. The business dependent on fragile margins feels it. The investor dependent on optimism feels it. But the owner with liquidity, productive assets, and emotional discipline experiences the same shock very differently. He may not enjoy it, but he can endure it and sometimes even use it. That difference is not luck. It is architecture. I want to go back for a moment to the middle class because people misunderstand what it means to wipe it out. They imagine some cinematic collapse where every family loses everything at once. Real life is slower and more deceptive. The middle class is hollowed out when it can no longer convert effort into lasting ownership. It is hollowed out when every raise is eaten by higher living costs. It is hollowed out when savings are too thin to absorb instability. It is hollowed out when each new crisis forces it to consume the future in order to survive the present. Oil shocks help produce exactly that condition. They are especially effective because they feel like inflation but act like a redistribution engine. They move money away from fragile household balance sheets and toward the parts of the system with pricing power. Reserves, ownership, and patience. If you do not own, you are often on the paying side of that transfer. That is why I tell people that an oil spike is not merely a commodity event. It is a sorting event. It separates people who own resilient claims on the economy from people whose plans depend on a permanently easy environment. And there is one more thing the crowd almost never prices correctly. The stories that dominate the news are not always the stories that dominate your results. Everyone loves the dramatic headline. A war, a policy fight, a recession call, those matter. But long-term wealth is usually shaped by quieter commitments. Whether you kept buying strong assets when others were afraid. Whether you built liquidity before you desperately needed it. Whether you improved your skills before your old job was automated. Whether you recognize that high spending and high confidence are not the same as financial security. These choices sound boring in calm times. In hard times, they look prophetic. When I was younger, people often wanted the clever answer. They wanted a hidden signal, a secret forecast, The perfect move. Age taught me that durable wealth is usually built by ordinary principles applied with unusual consistency. Spend less than you earn. Hold cash you do not glamorize. Buy productive assets, avoid unnecessary leverage. Do not confuse your house, your job, or your latest market opinion with real safety. Upgrade your skills faster than the economy upgrades its requirements. And when the crowd is frightened out of good assets, be prepared to buy instead of begging for certainty. This cycle adds one more principle. Do not ignore energy. A great many people spend their lives studying the visible parts of the economy while neglecting the invisible pressures underneath. Energy is one of those pressures. When it is cheap and stable, nobody wants to talk about it. When it jumps and stays elevated, everybody suddenly discovers that it was woven through almost everything they do. The wise investor does not wait for the rediscovery. He remembers it in advance. If you ask me whether the economy will definitely fall into recession from here, I will tell you something honest. I do not know the exact date, label, or path. If the conflict eases quickly, pressure can ease quickly. If energy falls back, confidence can recover. If policy changes or innovation offsets, some of the damage outcomes can improve faster than people expect. But if you ask me whether the middle class is vulnerable when energy behaves like a tax, labor markets are being reorganized by AI, and consumer confidence is already weakening, my answer is not uncertain at all. Yes, very vulnerable. And that vulnerability is not the end of the story. It is the beginning of your choice. You can remain a passenger in a system that grows harsher every time the cost of life rises. Or you can start building the posture of an owner. You can spend the next year hoping conditions become easy again. Or you can use the next year to build cash reserves, skill leverage, disciplined buying habits, and real asset exposure while the public argues about headlines. You can keep measuring your life by the size of your paycheck, or you can start measuring it by the strength of your balance sheet, the quality of your assets, and the number of bad options you can refuse. That is the real dividing line. The middle class is not only wiped out by inflation, it is wiped out by waiting too long to change identity. It waits too long to stop behaving like a consumer. It waits too long to become an owner. It waits too long to realize that safety is not promised by a job title, a mortgage, or a pleasant year in the market. Safety is built slowly, intentionally, sometimes painfully. And when the hidden tax arrives, the families who built it discover something the crowd never learns until it is too late. A bad cycle does not have to destroy you, but it will expose you. And once you are exposed, you either keep living at the mercy of the next shock, or you sign a new contract with your future self. The contract is simple. I will not depend on cheap energy, endless confidence, and a permanently easy labor market to carry my life. I will build enough discipline, enough ownership, enough liquidity, and enough judgment that when the next hidden tax moves through the system, it does not get to decide who I become. That is the test. Most people will fail it because they will wait for comfort first. A smaller group will pass because they will build before comfort returns. Decide now which group you belong to.